So now coming to the elephant in the room, right? Why private markets over public markets, right? And this is something which any investor would, stand up and say that, look, my public markets portfolio, my listed equity portfolio is compounding at 25, 30%, and we've seen a stellar run, right? The post-COVID raging bull run that we've seen, obviously aided by a lot of liquidity, aided by a lot of other factors which are beyond the business itself. But the earnings growth has been stellar. We are coming out of a great, coming out of a cycle where we've had very staid earnings growth the whole of the last decade. And the current decade, since 2020, has seen a very remarkable growth in earnings. And in that background, people often talk of the illiquidity premium, right? Is there such a thing called illiquidity premium, or should there be an illiquidity premium? And having said that, how does one measure and justify the illiquidity premium, right? Because, for example, in the seed stage, we have a lot of funds which are just simply spray and pray, right? They would invest across 60, 70 startups, hoping for 2 or 3 to become blockbusters with a 40-50% failure rate, right? Now, and often with a blind pool. Now, to such a scenario, an investor is better off, investing in a known pool of assets, investing in a listed universe where you have complete surety of exits, and you can monitor the valuation in a very transparent way on a day-to-day basis. Especially when you are coming out of a good cycle, it is very difficult for investors and even wealth management firms like us to wrap our heads around, this illiquidity premium. So I'll begin with you, Dr. A, and you can help us understand, first of all, should there be a illiquidity premium? And if so, how do you measure, how do you justify that?
So, I really loved this question because in the seed stage, particularly in the tech space, there are 2 critical gaps that determine this illiquidity premium. The first is the lack of adequate information, because you don't really know enough about where it's going. The second is the lack of adequate analytics. You don't even know how to figure out where it's going.
Right, because we seldom even understand the business itself or the technology, right?
Absolutely. So, in such an environment, you will always get mispricing. You'll get either overpricing or underpricing, and it takes somebody skilled in the art rather than the science to figure out whether something is grossly overpriced or underpriced. And I think that's where funds like us play a role. We are not only conservative, we are almost ruthless in saying that, okay, this doesn't pass the smell test. Even if it's not overpriced, we think it might be overpriced, we'll just pass it. So we pass an astonishing
number. For example, you've
number.
Invested in a fabulous chip design company, right?
Exactly, yeah.
How does one even come around valuing that?
Absolutely, I love this question. So if I can get slightly tech, there are 2 kinds of chips, very broadly. There are chips that do general purpose things, that the kind that are inside your laptop. And there are chips that do very specific things, chips that are, let's say, at a high frequency trading terminal. Now, the one in your laptop is a general purpose workhorse. It's like your Maruti Omni, right? It's a van, you can put lots of things in it. It won't give you performance on the road, right? The other end is like the Porsche. What these guys have figured out, it's a first in the world, they've taken 15 years to get there, homegrown at IISc Bangalore, is how to tune a chip on the fly to make the first kind behave like the second kind. Wow. And remember that the second kind would have to be thrown away if the use case changes. But if you can keep reconfiguring it, you never have to throw it away.
Wow.
So how do you value it? You value it by saying, what's the opportunity for a chip like that in the most critical use case? That's the only value I will believe, right? And so when we went in, it was at value X. 14 months later, they already have a term sheet for the next raise at value 3x.
Value 3x?
Yeah.
Wow. So, has the market figured out the use cases, which is what has taken the value so high?
So there are 2 things. One is getting your use cases sharpened, but the second is meeting your milestones. If somebody's made promises, their ability to meet the promises is a big marker in seed stage investing.
Wow,
Thanks.
interesting. Thank you. Coming to you, Sharad. In your case, it's at least a little more easier, I would suspect, than in the seed stage. But even there, I think because public markets have done so well, the ask from the private markets or the ask from the founders or the families who want to, probably invite private capital, that ask is also gone up significantly, right? We hear stories where founders often come up with numbers which are astronomical, and then given the fact that, they tend to believe that they understand their business better than anybody else. So in that debate, you often come out with a very lucrative valuation. So how do you do that, and how do you justify the illiquidity premium?
So this is a classic debate that always happens between public and private. Just taking a step behind, I think most of the private investments basically chase fundamentals. They will be, looking at the strong moat. They will be looking at the financials, and that's how they were going to basically, come out with their investment strategy. While in public markets, obviously fundamentals is one part, but liquidity also plays a very important role. Now, in the environment when there's a lot of liquidity happening, obviously the liquidity takes over the fundamentals, and you see the valuation sort of going up in one direction, and that's where people start envisaging that their returns are much better. We have seen last 25 years cycles between private and public, and the assessment here is obviously some years are very, very exciting to be in the public markets, but if you look at the overall longer periods, and not only in India, also in international markets, you will see normally public markets give you return of 14 to 15%. That is more widely acceptable. While in private markets, there has been the returns on the longer scale, I'm saying, it's going to be in this range of 17 to 18%. Now, we can always have the debate, is it 300 bips enough for you to take that kind of a risk? But one of the key points which we come across as investors are the kind of assets which you can get access to in a private market, you will not able to get those access in the public markets. Because private markets actually tend to, sort of invest in some of the futuristic businesses which are yet to become public. So from an asset diversification perspective, from an investor perspective, they always look at this asset class also where they can diversify themselves and get into those asset classes which can actually become much more important in next few years. So that can be only possible through an alternate assets, and then the debate can always continue, between the public and the private. There's no end to it, because some years will be good for public, some years will be good for private. Yeah.
Great. So access is one very important point that private markets are solving for, right? And coming to you, Abhishek, I think you are solving for a different kind of growth, right? Which if already was existing, then the company would have been listed by now. So do you even think about this particular aspect, or when you tend to take them public, or when you tend to even invest in them, do you have markers which tell you that, okay, what is a listed peer in the same segment, and should I really be pricing my entry in conjunction or in the context of, how much premium the market is already willing to pay for such kind of assets? And especially healthcare, or insurance, for example, where you have markers, you have listed peers. So how would you do this?
Sure. So first, to answer the question that you had, the first question that you had, asked all of us was, should there be illiquidity premium? Definitely yes. It should be ranging upwards of 300. I would rather say more like 500 bips. But as was rightly mentioned, that it provides you opportunities which are not necessarily available in the listed markets. To give an example, we have invested in 2 medical devices companies, and we saw this as an emerging sector across the last 10 years. But even till date, there is only one pure play medical devices company that is listed in the Indian markets. So how do you even play a sunrise sector if you are not coming into the private markets? Now, what is, I think the specific question that you asked me was with respect to, how do we look at justifying, the value that we are doing, the return potential of, our businesses. So as a control person, and not necessarily we will invest where growth is not available. We are backing emerging sectors, so there is growth. There is staffing solutions as a business that we have acquired through roll-up plays, which is growing very nicely. And so where the businesses are growing, you just have to make sure that either through bolt-on acquisitions or with respect to the right levers, get into the profitability mode as well, so that you can make it strategically more valuable, or you can take it to public markets. Where the growth is lacking, we need to see whether it is fundamental or whether it is because of certain reasons which is linked to the business, the way it is run, or people who are running it. So there could be a situation where the promoter is not spending as much time in the business because of certain other factors. Or it could be that they are happy with the growth that they are getting, but they haven't really ventured into newer geographies or trying to do different things. So we differentiate between business which are fundamentally inefficient and which will not do well. Despite how much effort you put in, we try to stay away from such businesses. But what we can solve through getting in the professionals, getting the business institutionalized, is what we would look to back. So that's the way we would approach this aspect.
Great.